Thanks for watching. And today we're going to talk about horizontal channels. And I don't want you to confuse those with trend channels. They're a little bit different. But horizontal channels, I find they're actually a pretty powerful chart pattern. And we can use them for swing trading various instruments, but I'm going to cover stocks in this video. And they are pretty simple to identify on virtually any time frame. So it makes it a pretty viable chart pattern for any trader to trade. And make sure you download this really popular price pattern guide that we have. It's free, and it's actually a really good addition to trading any type of channel or other chart patterns. And just make sure you hit subscribe and like this video. So what is a horizontal channel? It's a chart pattern. Okay, it's created when price action of an asset, that doesn't matter what it is, moves between two parallel support and resistance levels. You can trade both bullish and bearish trends, and these are going to form during periods of indecision and uncertainty in the market. Now, the main benefit of using these is that they actually give you very clear entry and clear exit points. And again, in addition, you can trade both long and short with these. And there's a lot of reasons why. Here's several that you'd want to use these to swing trade. First, as mentioned, it's pretty easy to find entry and exit points with them. Both the highs and the low boundary, they offer excellent trading locations. And this actually can be really helpful in managing your risk and obviously having a defined entry zone. Add to that, they're actually pretty reliable. Okay, this means they can be useful for identifying potential swing trading opportunities when this pattern does resolve, because during these channels we get volatility compression. So once this pattern breaks and it confirms, you could be on your way to some healthy run up in price. Another reason is that you could trade both long and short, right? It's the flexibility that they offer that can be pretty helpful when you want to adapt to the market conditions that are changing. And finally, they're actually pretty common. They form relatively frequently. This means if you know how to identify them and you know how to trade them, you could potentially find a number of trading opportunities. So how do you identify them? Well, there's a few things you want to look for. We want to find a stock, because I'm going to talk about stocks here, that's trading between two well-defined support and resistance levels or zones. These lines should be parallel, although it's not going to be perfect. You're going to get price splashing outside either the high or low zone. It doesn't matter. You just want to make sure that these lines cover the bulk of the trading activity at the highs and the lows. Also, got to make sure you find a stock that's made at least two clear swing highs and two swing lows, because we need that to draw the line. And that's going to confirm that there's an actual level there. Finally, some traders are going to use volume, and they want to see volume declining or very low during the presence of these channels before any breakout. And when you have the volume going down like that, it's an indication there's not a whole lot of interest right now in the stock, and that the price is likely to continue trading within that channel. There are a number of different trading strategies you can use. The best one, just like with anything, the best, it's going to depend on your own personal preference and your own risk tolerance. But here's some of the most popular ones. One is a channel breakout. You just wait for the price to break out of the horizontal channel, then you enter a position in the direction of the breakout. Now, for most breakouts, traders are going to want to enter price breaks in the direction of the current trend and avoid any break to the other side, which would be a counter trend. Oftentimes, a trader is going to use a pending order to accomplish this. So here, this first breakout on the left, it actually comes when the instrument is transitioning from an uptrend to a downtrend. You see that large red candle has enormous volume. That would give you permission to short another move to the downside. On the right, we have another breakout with increased volume. However, if you do have a pending order to short at the break, you could be doing so without seeing the increase in volume like you would see here. So to counter this, a lot of traders will wait for the breakout and then use a lower time frame to enter the trade. So how would you do that? This is a 1 hour chart. The daily chart had an obvious channel. So price broke out at the open, and a trader would just wait until the first 30 minutes or the first 60 minutes elapsed. And a trader would enter when price continues to the upside. We're just looking at a smaller range breakout. Breakouts are going to fail, right? People call it a false breakout. And this is where price will return back inside the range. This is the nature of the market, right? And traders that are going to trade a breakout, you have to accept that you may take a few breakouts that fail before price actually takes off. So to combat that, you can wait for the price to retest the channel after a breakout. But let's be honest, right? This is better described as a pullback strategy, because that's what we're really trading. Price had already broken out. We're trading the pullback and reversal. And again, enter long or short positions. So here, price was in an overall uptrend. We see a horizontal channel form after price had pulled back. We can see that on the left. So we get a breakout. And the candle with the arrow, that's not touching the resistance line. So this validates a breakout in my book when I'm looking for a pullback. I don't consider a breakout to be a breakout unless there's at least one candle not touching the resistance zone for a long trade. If I'm using breakouts for an entry, it's a little bit different. So here, price pulls back into the zone without momentum. Without momentum is vital. The inside bar sets up as an entry trigger, as does a typical reversal candlestick. A trader would buy stop the high or manually enter once price starts to break back to the upside. Trading the range, I'm not going to cover it. We have videos here on our channel. You can just search for trading ranges. Now, when we use a channel breakout or the retest strategy or any strategy, we have to place a stop loss. This is going to help protect your capital in case price reverses direction and moves back into the channel, and especially if it goes out the other side. Now, price coming back into the range does not invalidate the breakout unless momentum accompanies it or price just stalls. A good rule of thumb, place your stop loss order just below the support level for a long or just above the resistance level for a short. But if you decide to use the breakout pullback strategy, you may decide to place your stop loss under the reversal pivot. It's where you see the red horizontal line. But no matter what strategy you trade, you have to have a price zone that you're going to exit at if the trade goes against you, right? We don't want to let losing trades become trading account killers. Profits. Well, one option, set a profit target at the next level of resistance or support. This is going to help ensure that you're able to lock in some profits in case the price reverses direction. Another option is use a multiple of your risk amount. For example, exit the trade at 1 to 3 times your risk. It's a popular way to exit. Now, there's exceptions to this rule, and sometimes, especially when the market's volatile, it may be prudent to take profits a little sooner, especially if you see strong moves against you. Or simply use the height of the channel and project that from the breakout area. You can find your profit target that way. Bottom line, if you're unsure about when to take profits in a situation, always best to err on the side of caution. Take them sooner rather than later. Let's wrap this up. Horizontal channels, I like them. They can provide a really good opportunity for you to enter into profitable positions, especially once price runs, because eventually you'll catch those. But there's always risk involved, right? Never risk more than you're comfortable with losing. With channels, you get a defined entry point. That's something that can prevent you from trading with emotions, right? Either price breaks the level or it doesn't. There's no guesswork. You don't need an indicator for it. Bottom line, when you trade these channels, you got to place a stop loss order and take profit when the price reaches whatever you've outlined as your take profit strategy. They're simple rules, but by following them, you will increase your chance of success in trading, and especially when trading channels. Make sure you hit like, subscribe. We'll talk to you soon.